Corporate Finance, Excel practice problem. In this presentation, we're going to work a practice problem in Excel related to asset turnover and debt to asset ratios. And we're going to do a comparison from a period to period comparison to ourselves as the company, and comparison to industry standards. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side, calculating the return on assets and debt to asset ratios. We're going to be doing that for multiple periods, so we can have a comparison between multiple periods as well as a comparison to the industry standard, those being the two kind of comparisons we will typically use in order to give some context to the ratios to measure performance. How did we do period over period? How are we doing compared to the industry standard in terms of where we stand, as well as the trends that are happening over time? All right, so we got the return on assets. That's going to be calculated as the net income. So we're going to take the net income performance measure on the income statement. We're going to be dividing that then by the total assets, which is going to be on the balance sheet, of course. Now we have that difference between an income statement account and balance sheet account. Therefore, you might see the balance sheet account reported as net or average assets, the most common average being beginning total assets plus the ending total assets divided by 2. We're going to pick up the total assets in essence on the balance sheet here, which would be basically as of the end of the year total asset number. So just be aware of that. We're going to be picking up then the net income of the 418,500 and then the total assets of the 2,829,700. We'll divide that out then. This equals the net income divided by the total assets. Let's make that a percent. Home tab, numbers group, percent. We'll add some decimals. You can keep going on adding decimals. We will typically stop at 2. You're going to have to deal with rounding all the time when we are dealing with ratios. We're then going to underline. Let's underline here. Home tab, font group. We're going to underline there. So here we have our first year. So we got the 14.79. What does that mean? We're looking at how efficiently we're using our assets in order to generate the net income. So we don't really know if 14.79 is good unless we compare it to prior performance and to industry standards. So right now we can compare to the industry. I can say, all right, well, let's look at that compared to what the industry says. They're at this 13.92. I'm going to make this a percent. Home tab, numbers, percent, adding some decimals, 13.92. So we're doing better than the industry standard, but we're kind of in the ballpark there. So that looks like we're in the range compared to the industry standard. We don't have any other trend to be comparing to, so that's where we will stop there. Let's go then to year 2. Year 2, we've got the net income of the 4,487. We've got the total assets of the 3,236,400. Comparing those two, this equals the 4,487 divided by 3,286,400. Let's use the format painter now, selecting the 2 cells before. Home tab, clipboard, format painter. Then select these cells to put the underline and percent in place. So now we're going to say, if I was just looking at this number, I can say, well, now I have a bit of a trend here. It went down. That's not good, right? That's usually not as good. It didn't go down a lot, but you know, the trend is down. Then the net income, if we analyze the ratio, what happened to the ratio? Well, net income went up. That's usually good. That would usually increase the ratio. So what happened here? Well, the total assets also went up, and it went up by more. Again, you would think that would be good, but it's going to decrease this particular ratio because the net assets went up. Like if you had net income, it's going to roll in, it's going to possibly generate, you know, the assets, but the assets went up by more than the net income, which means possibly there was capital investment or something like that, more assets being purchased, more assets there, and the return on those assets then went down. And remember, our goal here for the company isn't just to have a stockpile of assets here. Our goal is to be using those assets to generate revenue. If the stockpile of assets gets high and we're not using them efficiently to generate revenue, we should be giving them to the owners in the form of dividends so they can then invest and make a return on their investment. So our goal here is to have the assets we need in order to generate revenue and be safeguard any kind of problems that could happen, of course, in the future as well. So we have a downward trend there, and so we're going to say then the industry, if I compare to the industry, and we make this a percent, let's format paintbrush this. The industry is much lower there, so we're doing much better than the industry. We can also calculate the change now. I can say, well, what's the difference? What's the difference in the trend that is happening here? And this is like a running change kind of formula we can have. We could say this is going to be equal to the return on assets minus the prior return on assets, making this a percent. Format painter, home tab, clipboard, format painter, paintbrushing this. Compared to the change here, this equals the prior year minus, the current year minus the prior year. We'll format paintbrush this cell. So now we had a decrease, but it was only like 1%. The industry went down by 5 or 6%. So we're looking pretty good there. Even though the downward trend is bad, if I was to look at it by itself, I'd say that's not so good. It didn't go down a lot, but it's not good. But hey, I only went down by 1% compared to the standard of the industry, which is going down 5%, and where we sit at this point in time is much higher and therefore better than the industry standard at this point. So let's look at the third year. We're going to say third year, we've got the net income compared to the total assets. Let's divide that out. This equals the net income over the total assets. We'll go ahead and format paint this. Let's highlight these 3 cells this time. Go to the Home tab, Format Painter, select these items. So I go, okay, now we're at 11.55. Once again, there's a downward trend, not typically good because that means we're not using our assets as efficiently to generate revenue. What happened in terms of the ratio? Well, we see net income went down. It didn't go down by that much though. It's pretty much the same. And then the total assets went up. So assets went up again. So assets went up and they didn't go up because of the income generation. Something else happened in order to increase the assets. Either we got some more capital investment, a loan, or equity investment and purchase more assets or something like that. But those assets didn't help us to generate the more income. What's going to be our downward? What's going to be our change? Let's take a look at our change. So the 1155 minus the 1318 means there's a 2 to 2.5% change in the downward direction. Let's compare that to the industry standard though. Industry standard, I'm going to highlight these 2. Home tab, clipboard, format, paint them, and then subtract them out. This equals the 4.6 minus the 8.41. So on the industry standard then, we're looking a lot better. If we look at that point in time, we're saying, yeah, we went down, the trend's going down, but we're at 11.55 compared to only 4.6 on the industry, and the industry went down by 3.81, and we only went down by 2. So even though we have a downward trend, if we compare to the industry, we're looking pretty good. And maybe there's some overall economic condition or whatever that's making the entire industry decline. And if we can hold on, if we're beating the industry standard, as the industry is on a economic decline for whatever reason, then that could be good, even though we see the decline. Now, if we look, we can also add these up, right? This is the change of the 2 periods, 3.24 compared to the industry change, the 9.32. So again, we're doing far better than the industry in that. So now let's compare the debt to total assets, remembering that debt to total assets represents, if we think about our accounting equation, assets represent what the company has, liabilities and equity says who has claim to it. Debt is going to be the third-party claim compared to the total assets. What we have, total, the claim, the third-party claim compared to what we have. This is a measure you can think of how much leverage we have. It might be termed leverage, meaning basically debt that we have, right? So we're going to say, all right, debt is going to be equal, we'll say debt is going to be divided by the total assets to give us the debt to total assets. Debt to total assets. Okay, so that's going to be the debt, we're going to say, is the 1,661,000 for year 1. Total assets, we're saying, are 297. If we divide that out, we're going to say debt compared to divided by the total assets. We'll then make a percent, home tab, numbers, percent. We can add some decimals. We could, of course, add more decimals. I'm going to stop it then at 2 decimals once again. I'm going to underline this item up top, home tab, font group, and underline there. So we've got the 5871. That's going to be our, the amount of the assets, what's been claimed to, the amount of the assets of the company, the amount that is claimed by third parties is going to be the 58% of total assets are basically claimed by the third party. That's going to be our liabilities. Now, again, is that good or bad? It really depends, again, on the industry standard and in our past performance. And debt's also one of those types of things where you could say, how much debt should a company have is a debatable question a lot of times for finance. Like, is debt good or bad? Or is it good up to a certain extent? When is the extent of debt too much now? Have you over-leveraged the company? Leveraging to some point might actually be good because it could increase revenue generation. But when is it too much? And people have arguments and different viewpoints on that. So then if we say then year 2, or if we compare that to the industry, let's compare it to the industry now. Say industry. We're gonna say the debt to assets, and I'm gonna make this a percent, home tab number percent, and let's add a couple decimals. So in general, you would normally think that of your assets, you would like the equity to have a higher percentage, because that would mean your net value of the company, assets minus liabilities, would be higher. Your book value of the company. Normally, you would think you'd want your debt to be lower so that your book value of the company is higher. But again, there's arguments that you want some amount of leverage, because if you can leverage and then make a return on the assets, then it would be good. So usually you'd want it to be lower. So if we say, okay, the debt to total assets is 58%, industry is 52%, so we have a higher debt to total assets. So normally, and it's getting a little bit on the high range, so normally we would think that that's not as good. So it's fairly close, but it's not as good because more debt, more of the assets are owned by liabilities in our company than in the industry standard. Okay, year 2, we've got the debt. We're going to compare that to the total assets. And dividing this out, debt divided by total assets. I'm going to use the format painter now, selecting these two. Home tab, clipboard, format painter. Selecting these two. And now we see a trend. It went from 58.71. It's going down to 56.50. Why? And that you would think would be kind of a good trend, right? Because now there's less of our total assets have claimed by the debt, and therefore have claimed by the owners of the business. Why did that happen? Well, it's not because the debt went down. The debt actually went up. But what happened is the total assets went up as well. So possibly that the things that could happen there is maybe we had revenue generation, but we looked at the net income, and it doesn't look like it's really the net income that's the cause of that solely. And it might be that there was an investment by the owners or something like that. As well, that would increase the total assets in comparison to the debt. So debt went up. You would think that would increase the debt compared to the assets, but it went down because the assets went up at basically a higher rate than the debt. So we have a decline in the debt to total assets. In general, you would think that would be good. If you compare it to the industry, we're going to say home tab numbers percent. The industry is quite a bit lower at this point and has a declining trend here. So if I subtract this out, we're going to say the 56.50 minus the 58.71. And then I'm going to go home tab, clipboard, format painter, paintbrush this. This is going to be the change. So we'll put the change here, and we'll put the change here. So we had a decline, which is kind of good, but it was only by 2.21, and on the industry, if we look at the 42.32 minus the 52 and format paint here, it declined by 9 to 10% versus 2 to 2.5%. Which so the industry is kind of looking better in that the industry, in other words, is in general less leveraged at this point than the company is at this point. And again, you got to be careful how much leverage how much debt you got that has claim to the assets, right? So we're gonna say then we've got the year 3, the debt compared to the total assets. If we divide this out, this equals the debt compared to the total assets. Then we're going to format paint. I'll format paint all three of these. Home tab, clipboard, format painter, paint brushing this. So once again, it's going down. Again, you would think that would be good in general. Why did it go down? Well, it's not because the debt went down. The debt went up again. But then the assets went up by a higher amount. Why might that be? Maybe there was earnings. Maybe there was earnings, that caused that, or possibly maybe there was capital investment by owners on the assets as well. So the assets increased, and that means that the debt to assets are going down to 50.24. So if we look at that change, we're going to say 50.24 minus the prior period. We have a change of 6.26. If we look at the industry standard, we're at 39.7. Going to format paint this item. So once again, we're still pretty lower, even though we have a good trend. You would think good trend down. The industry is far less right now, less leveraged than we are. If we take a look at the difference here, 39.7 minus the prior period on the industry, we're going to say that it declined by only 2 here. So we had a bigger decline in the second period, which is good. But in total, we're still more leveraged. If we look at the decline over the two period, we only declined by 847, whereas the industry declined by the 1240.